Steve Wruble, in your Premier Managers Fund, you select your favorite managers and you allocate assets accordingly. So which managers are doing best for you right now?
Well, Greg, right now we have managers that are exposed more so to equities that they're doing better. We've partnered with firms. Stadion is one of our lead names. The folks from Probabilities Fund are doing well. And I think the larger top to bottom approach is that these are all tactical, what we call tactical asset allocation managers, which means they can go across asset classes. And we found the danger with overexposure to a single manager, and the reason why we have 5 inside the fund is because they're all built on different methodologies, built for different market conditions. And what we've done is combine complementary strategies together. So on any given day, depending on what time period we're looking at, whether it's daily, monthly, the trailing last year, we'll probably have a different answer with who's outperforming.
And how often do you rebalance this particular portfolio?
The beauty of a growing fund is that it essentially rebalances itself with new cash flows in. At some point, that'll plateau, and then it becomes a quarterly rebalance between the 5 different managers. And they all have different time periods for how their underlying ETF selections change. Some are daily, some rebalance monthly. So there's really 5 moving parts, but the big picture, 20% each to 5 different strategies.
And you also use a tactical rotation fund, which uses ETFs to get your point across. Why ETFs? Tell me about how this fund is made up.
Tactical rotation, RX Tactical Rotation is one of our flagship products and where we have the largest amounts of assets right now. And really it's meant to compete in the purely quant space. And what we've done is further diversified. Most advisors and investors are familiar with the 9-sector S&P 500 rotation model. 50% of our fund is made up of a similar S&P sector model. The other 50% is made up of a global ETF model, which pulls from over 100 different ETFs. Both are purely quant methodologies, both complement each other. And why use ETFs? It's an efficient mechanism to gain exposure. From a macro quant point of view, a lot of times, or with this particular strategy, using quant on specific equity names would be way too complicated. What we're trying to do is get macro exposure to specific sectors, specific segments of the market based off of what's going on with the quant methodologies.
And what is that quantitative methodology telling you about stocks right now? Overvalued, undervalued, or is there a particular sector that's overvalued? What's it telling you?
As you know, we work with a number of managers. There's a slightly range of what they're telling us with regards to stocks versus bonds. In this particular strategy, RX Tactical Rotation, equities are showing momentum within the S&P 500. Utilities has probably the lowest momentum. Healthcare and biotech are very strong from a quant methodology. And then from the global piece of this, which is half of the funds, equities are still in favor. We've had some fixed income exposure, believe it or not, in some specific segments of fixed income over about the last 3 months. But it's leaning towards, as you would expect, looking at some trailing performance. We've got some mid-cap and domestic exposure and biotech that's overweighted.
All right, thanks a lot, Steve.
All right, thank you, sir.